So $724.1 billion. That was the big number for U.S. retail sales back in April 2025.
Right.
But then you look at how it changed from March, and it's up. Just 0.1%. 0.1. I mean, does that really scream strong economy to you?
Not exactly. It feels pretty sluggish, right? Almost like consumers are maybe, finally hitting a wall with high prices or just feeling uncertain.
Yeah, it makes you wonder if the spending engine is kind of sputtering out. But then you look just a bit deeper in that same report, April 2025 again, and compared to the previous April 2024, sales were up 5.2%.
Yeah, 5.2. That's a solid jump.
Exactly. So how can both things be true? Flat month to month, but pretty strong growth year over year. Are people spending freely or are they pulling back? It feels like there's a real disconnect, maybe, between these big national numbers and, well, what you might be feeling personally or what you hear businesses saying.
It's a classic case of the headline not telling the whole story.
Okay, so let's investigate this. We're doing a deep dive today into the latest figures on U.S. retail sales and consumer spending. And to get a handle on it, we've gathered, well, a few key sources. We've got the hard numbers from the U.S. Census Bureau's April 2025 report.
The official stats.
Right. Then we have the on-the-ground intelligence from the Federal Reserve's May 2025 Beige Book. That's where they talk to their contacts all over the country, businesses, community folks, getting that qualitative feel.
Yeah, the stories behind the numbers.
Exactly. And we're also layering in some specific analyses focusing on big trends like, the huge growth in e-commerce, and maybe most importantly, digging into who is actually doing the spending right now.
Which turns out to be crucial.
Right. So our mission here is to sort of cut through the confusion, figure out how strong the American consumer really is at this moment. We need to look past the averages, peel back the layers, see who's spending, where they're spending, and what's driving those choices.
It's fascinating, that tension you pointed out right away. That tiny, almost zero monthly change versus the pretty substantial year-over-year growth. It tells you immediately that any simple answer, consumers are strong or consumers are weak, is just missing the point. The census report gives us the bones, total dollars, the main categories. But it's the Beige Book that really adds the color, the sentiment, the regional differences that get lost in a national average.
Yeah.
And then these other analyses on income, on online shopping, they help explain the why, the shifts underneath the surface.
It really is like putting together a puzzle, isn't it? Census is the big picture view from above.
Quantitative, yeah.
The Beige Book is down on the street, hearing what people are actually saying and feeling.
More qualitative, texture.
And the other pieces zoom in on these critical factors like income or online shifts that affect the whole thing.
Absolutely. You need all of them.
Okay, so let's start with that foundation. The Census Bureau numbers for April 2025. What are the key figures we need to understand first?
Okay, so the total advance estimate, remember, it's an early look for retail and food services sales in April, was $724.1 billion.
Right.
Now, compare that to the revised number for March, which was $723.7 billion. So, like you said, that's an increase of just 0.1%. month over month.
0.1%. It feels tiny for such a massive amount of spending. And the report mentions something important about that 0.1%, the confidence interval.
Yes, exactly. And this is really key for understanding that small change. The Census Bureau gives a 90% confidence interval, which for April's 0.1% was plus or minus 0.5%.
Okay.
And the crucial part is what they state explicitly. The 90% confidence interval includes 0.
Which means?
In plain English, it means that statistically, based on their sample, they can't confidently say the real change from March to April was actually different from 0. It could have been up a tiny bit, down a tiny bit, or effectively no change at all. The number is too small and the margin of error too large relative to it to be sure it wasn't just statistical noise.
Wow. Okay. That really underlines the feeling that April wasn't a month of much progress. It was basically stalled, statistically speaking, compared to March, once you account for seasonality.
Exactly. It suggests a pretty significant slowdown compared to the month before. But now let's look at that year-over-year number, because that tells a very different story about the overall level compared to 12 months prior.
Right, the 5.2%.
Yep. Total sales in April 2025 were up 5.2% from April 2024. The confidence interval on that is also plus or minus 0.5%, but that range, 4.7% to 5.7%, is clearly way above 0. So while the monthly change was a statistical blip, maybe, the year-over-year growth was definitely real and substantial.
Okay, so this is where it gets interesting. Stalled versus March, but way up versus last April. How did April's stall compare to March's actual performance? Was March strong?
March was definitely stronger on a monthly basis. The revised number for March showed sales were up a healthier 1.7% compared to February.
Okay, 1.7%. That's quite a bit more than 0.1.
Absolutely. So April really represents a loss of momentum compared to March. March had solid sequential growth, but in April, that seemed to just evaporate. It looks like spending hit pause.
Got it. Solid growth in March, then a pause in April, but still sitting much higher than a year ago overall. Now, before we get into what people bought, the Census Bureau mentions how they get these numbers and the fact that they get revised. Why is that important for us to keep in mind?
It's crucial because these are advanced estimates. They're designed to be quick, give everyone an early read. But that speed means they're based on a smaller sample, about 4,800 firms out of, over 3 million retail and food service businesses.
Just a fraction then.
Right. And they weight that sample up and benchmark it. But later they incorporate more data. The report mentioned recent revisions from late April 2025. These happen periodically, reflecting things like historical corrections, data from more comprehensive annual surveys like the 2022 Annual Retail Trade Survey, changes in industry classifications like NAICS updates, and even adjustments to only include firms with employees to match other economic data.
So why should we, watching this data, care about those technical revisions?
Because the first number you see isn't always the final word. Those big annual surveys capture way more businesses, especially smaller ones. When that richer data comes in, it can sometimes change the historical picture noticeably. Understanding that these advanced numbers are preliminary helps manage expectations. You shouldn't, bet the farm based on one decimal point in an advance release. The picture gets sharper over time.
That's a really good caution. Look at the trend, but don't obsess over the exact initial digit. Okay, let's get into the details then. Table 2 in the report breaks down sales by category. What stands out when you look at the month-over-month changes for April?
Well, reflecting that overall flatness, the total was up 0.1%. But if you strip out food services, restaurants, and bars, actual retail sales were down slightly, minus 0.1% for the month.
So spending on stuff actually dipped a bit in April.
Yeah, it suggests maybe dining out held up okay. Food services were flat month on month, while buying goods softened just a touch.
Were there any retail areas that actually grew in April compared to March?
There were a few. Building materials and garden supplies were up 0.8%, maybe people starting spring projects.
Makes sense.
Electronics and appliance stores saw a small 0.3% increase, and furniture stores were also up 0.3%. And if you look at that core retail measure, total sales excluding cars and gas, that managed a small 0.2% gain.
So home-related things, electronics, small increases there. Where did we see spending pull back month over month?
The weakness was more widespread. Motor vehicles and parts dealers, which is a huge category, dipped slightly, minus 0.1%. Food and beverage stores were flat overall, but grocery stores specifically were down 0.1%.
Even groceries?
Yeah. Health and personal care stores down 0.2%. Gasoline stations, often driven by price changes, saw a bitter drop, minus 0.5% month over month. Clothing stores down 0.4%. And some discretionary areas took bigger hits. Sporting goods, hobby, musical instruments, and bookstores dropped a significant 2.5%.
Wow, 2.5%.
Yeah. General merchandise stores down 0.2%.
Right.
The department stores down a sharper 1.4%. Miscellaneous store retailers down 2.1%. And even non-store retailers, which is mostly online sales, they were flat, 0.0% change in April compared to March.
Man, that monthly breakdown for April is really messy. Big drops in sporting goods, clothing, miscellaneous.
Yeah.
Slight dips in basics like groceries, health stuff. Even online went flat. But then small gains for home improvement and furniture. It really sounds like consumers were being super selective, maybe hesitant.
It absolutely screams caution, doesn't it? It really backs up that statistically flat headline number. There just wasn't broad growth from March to April. Now, overlay the year-over-year numbers because that's where you see the underlying strength that pulled the total up 5.2%.
Okay, yeah. What looked strong compared to April 2024?
Big ticket items held up well year-over-year. Motor vehicle and parts dealers were up a very strong 9.4% compared to April 2024. Auto dealers specifically up over 10%.
1%. Okay.
Health and personal care stores also showed robust yearly growth, up 8.5%. Miscellaneous store retailers up 6.0%. And non-store retailers, our online proxy, up a solid 6.1% year over year. Food services, eating out, also up a decent 4.6% compared to last year.
So cars, health products, online shopping, restaurants, all showing solid gains compared to a year ago. Where was the weakness year over year?
The biggest drop year over year was gasoline stations, down 6.8%. That's almost certainly more about lower gas prices this April compared to last April, rather than people driving massively less. Lower prices there can actually free up cash for other things.
Good point.
Electronics and appliance stores were basically flat year over year, up just 0.1%. Building materials up a modest 3.2%. Food and beverage stores saw decent growth, 2.7% year over year, same for grocery stores specifically. Clothing up 3.5% YOY, sporting goods up 1.7%. General merchandise up 2.8%.
Okay, so if we put the monthly hesitation and the yearly strength together, it seems like people are definitely spending more dollars overall than last year, especially on cars, healthcare, online, eating out. The gas station drop is likely price-related. But that April monthly data, with pullbacks in discretionary areas and even flat online sales, that feels like the more current pulse, suggesting caution crept in at the start of Q2.
I think that's exactly right. The yearly numbers reflect momentum from the past 12 months, maybe. Wage growth, accumulated savings, wealth effects. But the April monthly numbers, especially the weakness in clothing, sporting goods, miscellaneous, and that pause in online growth for that month, suggest consumers tapped the brakes a bit as the second quarter began. The strong auto sales year over year might reflect pent-up demand finally being met, or simply that people who buy new cars are still feeling pretty confident, even if the monthly pace eased slightly.
Okay, so the census numbers paint this picture. Stalled monthly momentum in April after a better March, but within a context of sales still being significantly higher than a year ago, with lots of variation between categories. But numbers are just part of it. To get the why, the feeling, we need the Beige Book. What did the Fed's contacts tell them in the May 2025 report?
Right, the Beige Book gives us that crucial qualitative perspective based on conversations through mid-May. And nationally, the main takeaway from the 12 Fed districts was that overall economic activity actually declined slightly since the last report.
Declined slightly.
Yeah.
That definitely sounds more downbeat than the 5.2% year-over-year retail growth.
It absolutely does. And look at the breakdown. Half of the districts reported slight to moderate declines in activity. Only 3 reported no change, and just 3 reported slight growth. So it's definitely a mixed picture, but leaning towards slight contraction or stagnation in recent weeks, according to these business contacts.
It's quite different from the positive spin you sometimes hear based on aggregate numbers. Was there a common theme explaining this slight dip?
Yes, a really big one echoed across all the districts. High levels of economic and policy uncertainty. This wasn't just background noise. The report emphasizes it's leading to real hesitancy, making businesses and households cautious about making big decisions. That cloud of uncertainty hangs over the whole report.
Uncertainty about the economy, policy decisions.
Yeah.
Yeah, that would make anyone pause. How did this show up specifically in what the Beige Book heard about consumer spending?
Well, consistent with the overall slight decline, the Beige Book said consumer spending reports were also mixed, but most districts reported slight declines or no change. This aligns much better with that flat monthly picture from the April census data, not the strong year-over-year one.
Can you give some examples from different regions? Did the caution look different across the country?
Sure. Boston noted a modest slowing in retail and restaurants. Cleveland contacts reported a definite pullback in consumer spending. Minneapolis said spending fell modestly. And interestingly, contacts there mentioned patrons were spending less per visit at stores and restaurants. That's a clear sign of caution.
Cutting back even when they do go out.
Exactly. Now, on the other hand, Richmond saw a slight pickup, and Chicago reported a modest increase. So there was regional variation.
So even within that national trend of slightly down or flat spending reported by businesses, some areas were doing okay, while others were seeing consumers actively cutting back or spending less each time. How does that regional detail complement the big national census number?
The census gives us the indispensable national total, the aggregate flow, but it averages everything out. The Beige Book shows us that the American consumer isn't one thing. Spending patterns, confidence levels, they can differ quite a bit depending on where you live, what industries dominate there, maybe even just local sentiment. The Beige Book adds that vital texture, revealing the diverse realities behind the average.
That's crucial. The average can hide a lot.
Yeah.
So given this uncertainty and mixed spending, how are businesses reacting? What are they telling the Fed they're planning to do?
They're reacting cautiously, especially on forward-looking stuff like hiring. Several districts mention hiring pauses or increased reluctance to add staff. Staffing firms in Boston, Atlanta, Philadelphia, Kansas City all reported this hesitancy. And even more telling, Minneapolis, Atlanta, and St. Louis contacts said some firms were actually drawing up contingency plans for layoffs if things don't pick up.
Wow, planning for layoffs. That signals a real shift in mood, a defensive stance driven by that uncertainty.
It really does. And it's not just hiring. Capital spending, business investment is also affected. The Beige Book said overall capital spending was largely unchanged, but some districts saw planned cutbacks. New York manufacturers and wholesalers, for instance, were scaling back some investment plans.
So businesses are tapping the brakes on hiring and investment because of this uncertainty, even while the year-over-year sales data looks decent. Again, it feels like the Beige Book captures the current mood and future intentions, which seem more cautious than the backward-looking yearly sales might suggest.
That's a perfect summary. The yearly growth reflects the past, maybe some pale winds. The Beige Book sentiment reflects the current headwinds and the caution shaping near-term decisions.
Which leads us back to, who is doing the spending that's holding up that year-over-year number? And are there other big forces shaping habits? This is where the AP News and Sellers Commerce Insights really shed some light. What did the AP piece say about the split in spending based on income?
The AP article highlighted a really key finding from recent Fed research that helps explain this puzzle. A lot of the strength in retail spending, especially in those aggregate numbers, is increasingly being driven by wealthier Americans.
Wealthier Americans, why is that? I mean, given all the talk about high prices.
Well, the research points to huge gains in wealth for this group, particularly since the pandemic started. We're talking strong income gains, sure, but even more dramatic increases in home equity and stock market wealth.
How dramatic?
The numbers cited are pretty staggering. The wealthiest 10% own something like 80% of the stock market value. From early 2020 to mid-2024, their home equity jumped 70%. That's about $17.6 trillion in added home equity for just that top group.
17 trillion. Wow.
And over that same period, their stock and mutual fund wealth grew 86%, adding almost $37 trillion.
Okay, let me process that. Trillions and trillions in new wealth concentrated at the top.
Exactly. And this massive increase in wealth acts like a cushion. Affluent households can keep spending, even increase spending, without relying solely on their paychecks. Their balance sheets have expanded enormously, boosting their confidence and ability to spend.
And how does that compare to lower-income households?
It's a totally different reality. Lower-income families are getting squeezed much harder by rising costs for essentials, rent, groceries, utilities, things that eat up a bigger share of their budget. They simply have less left over for discretionary spending, the kinds of things we saw weakening in the monthly census data, like clothing, hobbies, maybe some home goods.
So one group feels much richer from assets and keeps spending, while the other sees essentials taking up more and more of their income, forcing cuts elsewhere. Did the Fed study actually quantify that difference in spending growth?
Yes, it did, and the numbers really show the split. Looking at inflation-adjusted spending on retail goods from January 2018 to August 2024, the upper-income group spending grew 17%, middle-income households' growth was 13.3%. But for lower-income households, spending grew only 7.9% over that whole period. And even more striking, the study found lower-income spending actually fell between mid-2021 and mid-2023.
Spending actually went down for lower-income folks for 2 years. That really drives the point home. The average looks okay, maybe even good, but a big part of the population was actually cutting back.
It shows how much those aggregate growth numbers, like the 5.2% year-over-year figure, are being pulled up by the spending power at the very top. The study also looked at discretionary spending as a share of income. Since the pandemic, that share has fallen for the bottom 3 income quintiles, but it increased for the wealthiest quintile. That tells you who feels comfortable spending beyond the absolute necessities.
That's a powerful contrast. Lower-income families cutting discretionary spending, while wealthier families are dedicating more of their income to it. Are there other signs of financial stress for lower-income consumers mentioned?
Yes, unfortunately. The AP article pointed to rising delinquencies on credit cards and auto loans, reaching levels not seen in about a decade for these groups. The Beige Book echoed this too. Contacts in Kansas City and San Francisco specifically mentioned rising delinquencies and financial stress among clients. Some people were seeking debt consolidation, which is a clear sign of struggling to keep up.
So the picture is becoming clearer. Aggregate spending is being propped up by wealthy households benefiting from asset booms, while lower-income households are under pressure, cutting back on non-essentials and showing signs of financial strain like rising debt problems. That really helps explain the mixed monthly data and the cautious Beige Book tone.
Absolutely. It explains why the picture is so mixed and uncertain, because the experience is diverging sharply based on income and wealth.
Okay, let's shift focus slightly. You mentioned e-commerce as another major factor. How does the rise of online shopping fit into all this?
Yeah, the Seller's Commerce Source provides a good look at just how big and persistent the e-commerce trend is. It's not just a blip, it's a fundamental shift that keeps growing. U.S. e-commerce sales hit roughly $1.19 trillion in 2024. The estimate for 2025 is $1.29 trillion. That's almost 9% growth. And they project it hitting $1.88 trillion by 2029. It's a huge and consistently expanding part of retail.
Over $1 trillion and still growing fast. What slice of total retail sales does online represent now?
In the last quarter of 2024, it was nearly 18%, 17.9%. For the full year 2024, it was just over 16%. And that share has been climbing steadily for years, with a big jump during the pandemic in 2020, obviously.
Right. So even when overall retail has these monthly wobbles, online sales seem to be on a strong upward path long term. How does that connect back to the census categories we discussed?
Well, the census category non-store retailers is mostly online sales. And remember, while it was flat month over month in April, matching that overall pause, it showed strong year-over-year growth of 6.1%.
Ah, okay.
That lines up perfectly with the Seller's Commerce data showing consistent, strong annual growth. It confirms that a big chunk of that overall 5.2% year-over-year retail sales growth we saw is coming from this ongoing shift to online purchasing. The flat month in April might just be part of the general caution that month, but the underlying trend is a major driver of overall retail expansion over time.
That makes sense. The online shift provides a strong baseline current, pushing the yearly numbers up, even if the monthly flow hits occasional slowdowns. Okay, so you have the numbers, the mood, the income split, the online trend. Let's bring in tariffs and prices. The Beige Book mentioned tariffs frequently as a source of uncertainty. How are they playing out?
Tariffs were definitely a recurring theme in the Beige Book, contributing significantly to that widespread economic and policy uncertainty businesses reported. And it's not just abstract worry, it's having real effects on costs and decisions.
What kind of effects? What are businesses telling the Fed?
They're saying tariffs are directly increasing their costs. Manufacturers are paying more for inputs, retailers are paying more for imported goods. Contacts in places like Cleveland, St. Louis, Atlanta specifically blamed tariffs for recent cost hikes. And the uncertainty itself is a problem. Businesses in Philadelphia and Kansas City said it was hard to even set their own prices when they didn't know what tariff costs might look like down the road.
Higher costs and pricing headaches. How are companies dealing with that?
In a few different ways. Some are trying to eat the costs, absorbing them into their margins, like a coffee importer mentioned in Philadelphia who worried about losing customers if they raised prices.
Taking a profit hit.
Right. Others are planning to pass the costs along. Manufacturers in St. Louis and San Francisco, shipping contacts in Kansas City, they indicated that they intended to raise prices. Some are trying to avoid the issue by looking for domestic suppliers instead of importing contacts in Cleveland, and New York mentioned doing this. And some are undertaking bigger shifts, like reconfiguring their entire supply chains to source from different countries, as reported in Atlanta and New York.
Rejiggering whole supply chains. That sounds expensive and disruptive just because of tariff worries.
It's a major headache, and the uncertainty about when tariffs might hit is causing some distortionary behavior. The Beige Book noted businesses were front-loading shipments, rushing imports in early to try and beat potential deadlines. Richmond saw a port surge because of this. Kansas City saw accelerated purchasing.
Stockpiling before prices potentially jump? Does that cause problems?
Yeah. The Beige Book contacts mention knock-on effects like higher global shipping costs because everyone's rushing at once, surge pricing on spot markets, and even resorting to more expensive air freight just to get goods in before tariffs might apply, according to Kansas City contacts.
Okay, so all these extra costs for businesses, higher inputs, supply chain disruptions, rush shipping, air freight, it feels like eventually that has to show up in prices for consumers, right?
That's exactly the concern highlighted in the Beige Book. While current price increases might be modest overall, many business contacts expect substantial input cost hikes in the coming months due to these tariff pressures. The Boston district was pretty blunt, saying non-trivial price increases on consumer goods were expected by summer. And the Economic Times piece, though looking back at January, noted consumer caution then was partly fueled by worries that tariffs would drive up inflation, leading people to hold off on big purchases. So even the anticipation of tariff-driven inflation can dampen spending.
So tariffs aren't just some abstract policy debate. They're flowing through business costs, messing with supply chains, creating expectations of higher consumer prices, which then feeds back into consumer caution. It's a whole interconnected cycle.
It really is. And that cycle of uncertainty, costs, and potential price hikes from tariffs is a key headwind right now, alongside the uneven financial health of consumers.
Okay, let's try to pull all these threads together now. We've got the census data, the Beige Book mood, the income split, e-commerce, tariffs. What does this all mean for the big picture of U.S. consumer spending right now?
Well, when you synthesize it all, you definitely see a picture that's way more complex than any single headline. There's a clear disconnect between some of the aggregate data, like that 5.2% year-over-year retail growth or historical GDP numbers, and the much more cautious, mixed to slightly negative vibe coming from the Beige Book's ground-level reports.
Right. The rearview mirror looks okay, but the view through the windshield seems foggy and uncertain.
Exactly. And that divergence seems largely explained by who is doing the spending. The solid yearly growth is heavily buoyed by affluent households who've seen huge asset gains. But underneath that, lower-income households are facing real pressure on necessities, they're cutting back elsewhere, and showing signs of financial stress, like rising debt problems. That unevenness is critical. Then you layer on the widespread business uncertainty, especially around tariffs, which is pushing up costs, disrupting supply chains, and leading to expectations of higher consumer prices soon.
And the Beige Book also touched on the community impact, didn't it?
Yes, briefly but importantly, it noted nonprofits are feeling squeezed by funding cuts and rising costs from tariffs, making it harder to meet increased demand for basic needs, housing, food, healthcare assistance. Childcare access was also mentioned as a challenge. It just highlights that these economic pressures aren't abstract. They hit vulnerable communities and the organizations trying to help them.
It really underscores that uneven impact we saw in the income data. So putting it all together, the flat April sales, the solid yearly growth, the big income divide, the Beige Book caution, the tariff uncertainty. How would you characterize the state of consumer spending overall?
I'd say it's an economy where consumer spending is neither uniformly strong nor collapsing. It's segmented and cautious. The aggregate numbers, especially year over year, look okay, mainly because of the spending power at the top, fueled by wealth. But below the surface, many consumers, particularly lower income ones, are under pressure and pulling back, showing strain. Businesses are navigating significant uncertainty, mostly policy-driven like tariffs, which raises costs and makes them hesitant about the future, expecting to pass price hikes along. So it's not a boom, not a bust. It's complex, uneven, with underlying strengths for some, real pressure for others, and a lot of uncertainty affecting decisions everywhere.
Segmented and cautious. That resonates with all the conflicting signals. What about the outlook? What did the sources suggest?
The Beige Book outlook was definitely mixed. Contacts ranged from cautiously optimistic to quite pessimistic. The big theme was that the high uncertainty makes planning very difficult. The economists cited in the AP piece sounded maybe a bit more hopeful overall, suggesting the worst inflation or rate pressures might be easing. But even they acknowledged the cracks, especially concerning lower-income consumers' financial health.
So maybe some cautious optimism, but shadowed by real concerns about uncertainty and the struggles of a large part of the population.
Precisely. The path forward seems to depend a lot on whether that uncertainty lifts and how the financial strain on many households plays out.
Okay, let's wrap this up. What are the absolute key takeaways from this deep dive for you?
Okay, first, April 2025 retail sales were basically flat month over month, statistically speaking, signaling a pause. But they were still up substantially, 5.2% compared to the previous year.
Second takeaway. The yearly strength is heavily driven by wealthier consumers benefiting from huge gains in assets like stocks and home equity.
Third, lower-income consumers are feeling the pressure from essential costs, cutting back on discretionary spending and showing signs of financial stress, like rising delinquencies.
Fourth, tariffs are a big source of uncertainty, raising business costs, causing supply chain weirdness like front-loading, and leading businesses to expect they'll have to raise consumer prices soon.
And finally, the overall picture is really uneven across income groups, across regions. Aggregate growth hides significant disparities and a lot of caution among both businesses and consumers, fueled by that uncertainty.
That paints a much richer and, frankly, more complicated picture than just looking at one number. So here's a final thought to leave you with, something to maybe chew on. If the strength we see in overall spending is increasingly dependent on the wealthiest segment, fueled by asset gains, what does that mean for how stable or sustainable this economic expansion really is? How resilient is this picture if asset values wobble, or if the pressure on most households keeps building.
It really gets to fundamental questions about how broadly the benefits are shared and how durable consumer demand truly is going forward.
It certainly does. Keep an eye on the data. Look beyond those averages, because the story of the American consumer is complex, and it seems like different chapters are being written for different people right now.